Good morning. So we continue with balance of payments, and today we end the chapter of balance of payments. So yesterday we talked about trading goods and trading services. The income that is derived from that current account is called primary income. So when we trade in goods or services, what comes to us as individuals or as a country is called the primary income. So what does the primary income contain? Here I got primary income. It results from the loan by factors of production abroad. This means income is generated from interest, which is from capital, dividends from our shares abroad, and profit because we have other businesses to do abroad. So all the factors of production, land, labor, capital, enterprise, the reward for them are what we get because we own them abroad. Get the point here? If we have land abroad, if we have capital abroad, if we have enterprise abroad, if we have land, labor abroad, all what we generate are what we call the primary income. We call them primary income because there was a job, there was an output before we get that income. Do you get primary income here?
Yes.
Output was done. There was an output based on the fact that there were inputs before we got the money. So all the money we got because we have made an action or we have done some things are called primary income. Then we have secondary income. For secondary income, here there's transfer of money without output. Get the difference here. Primary income, it's when there was transaction, there was exchange for that income. But for secondary transaction, for secondary income money, for secondary income, there is no transaction. Do you get the difference between primary income and secondary income? Both of them are items in the current account. They are items in the current account, but they are different. Primary income is the income generated from factors of production. Secondary income is not. Output was not involved. It's just like my personal money I transferred to Nigeria. There was no output in Nigeria, right? So I'm transferring that money to Nigeria. The government of Libya is giving the government of Turkey some certain amount of money. There's no output. So these are free money. There was no output in exchange. We call it secondary income. Do we understand secondary income here? Yes. So Libya receiving money from America, it's also a secondary income. Me receiving money from Nigeria down here is a secondary income if there is no output. Do you understand the difference between primary income and secondary income? Primary income involves the factors of production. Secondary income does not involve it. Is it clear? Great. We move on. So what is the difference between balance of trade deficit and balance of trade surplus? We already know that BOT is the value of export minus import. We talked about that yesterday. The value of our export minus import gives us our balance of trade. What we are exporting minus the value in terms of what we are exporting minus the value of what we are importing gives us our balance of trade. Trade means import and export. So the balance between them is what is coming out of our country and what is coming in to our country in terms of the monetary value. I think that is clear. So why do we call it surplus? We call it surplus when exports exceeds imports. So if our exports, our trade in export is more than trade in imports, we call it balance of trade surplus. Do we understand BOT surplus here? BOT surplus means our export is more than import. Clear. Then we have a deficit. It becomes a deficit if our import is greater or exceeds our export. Do we understand deficit and surplus? BOT surplus means export is more than import. BOT deficit means import is more than export. I think it's clear. So that takes us to the balance of payments now. There's a difference between balance of payment and balance of trade. The balance of payment contains the current account. The balance of trade is about our trade in goods, our trade in services, export and import. So for the distinction there, note, the current account of balance of payment consists of the primary income. Remember our primary income is from our trade in goods and services. That's where we get our primary income. I said that earlier. Our primary income is from our trade in goods and services. This is our factors of production. We have blown our factors of production out. That gives us our primary income. The secondary income are income that we get without any output. Either government transferring money to another government, or I am transferring personal money to my family or to a friend. These are secondary income. It's part of our items in the current account. Then we have the value of goods and the value of services. So it has both credit and debit side. So for our current account, it has the debit side and the credit side. So what makes them different? On the debit side, we have, for our current account balance, it has to balance. If it does not balance, it means we have a deficit or a surplus. Why do we call it a current account surplus? We call it a current account surplus if the overall credit value is more than the overall debit value. I said already that we have the debit side and the credit side. The credit side entails what comes to our country. The debit side entails what goes out of our country. I think we get it now. So on the credit side, if the overall value of the credit side exceeds the overall value of the debit side, we call it current account surplus. Overall, on our credit account is more than our debit side of that account. We call it current account surplus. On the other hand, if the overall debit is more than the overall credit, we are having a current account deficit. Do we get it? The difference between balance of trade, surplus and deficit, and current account surplus and deficit is that here we're talking about exports exceeding imports for surplus, import exceeding export for deficit. Here we're talking about the credit side more valuable than the debit side. That means we have more value in terms of what we generate on the credit side than the debit side surplus. But if our debit side value is more than or greater than or exceeds our debit side, it is a deficit. Do we understand the difference between current account deficit and surplus, balance of trade deficit and surplus? I think they are clear now. Great. Then the last thing we need to talk about is government deficit and balance of payment deficit. But before I go into this, there is government deficit. Government deficit will come as a result of government spending. Government owns this country. They are the one in charge. They spend on us. So whenever government spends so much that they are having a deficit in the current account, it would have meant that in the course of government spending, they have borrowed some money from abroad. Please, you have to get this fact clear. If government is spending in this country, and government is using its own money that is generating its own revenue to spend, government will not go into current account deficit. So if government is going into current account deficit as a result of spending, it would have meant that government has also borrowed from abroad to finance that spending. So if government has to borrow from abroad to finance the spending, it means the money generated, the revenue generated from government, by government, is not enough for their spending. Government will spend. Government spend through their revenue. So government will finance their revenue through what they generate, maybe from taxation or from oil. Example, the Libyan government. So if the Libyan government has to spend and is going into current account deficit, it would have meant that the Libyan government is spending more than what it has. Then how did it spend? It means the Libyan government has taken money from abroad. That is why the current account of Libya is going into deficit. But if the government of Libya is spending what it generates, then it's not going to have a current account deficit. Do we get it or not? There's current account deficits. If there's current account deficit from the government, that is government deficit. So government deficit will come as a result of government spending more than what it generated. So if the government of this country spends more than what it's generating, it would have meant that the government of this country had borrowed money from abroad, from other countries, to be able to finance the spending. That will bring about current account deficit. But we have to put in mind that it is not only government that does import and export. We individuals do import and export. Firms do imports and exports. So billions of transactions are done by individuals. Do we get what we're talking about here? There's government spending, yes. But when we talk about import and export, it is not only from government. Individuals does imports and exports. So if individuals, they borrow so much, if individuals do more of imports than exports, and they have to pay the money from borrowing from abroad, it will lead to current account deficit. Do you get the two situations now? Yes. Government could put us into current account deficit if government spending is financed through borrowing from abroad. It will lead to current account deficit. Please stop writing. That is from government side. But on the other side, if individuals, firms, have to do more of imports by borrowing to pay for such imports, it will lead to current account deficit. Do we understand the two situations here? So how do we now do it? It is left in the hand of government to decide either to correct that deficit or not. For government deficit, government has to correct it, not individuals. So how does government correct it? Government will reduce spending or reduce borrowing from abroad. So government will stop borrowing from abroad to correct current account deficit. But if the current account deficit is as a result of individuals importing more than exporting and borrowing from abroad to pay for such imports, then government might choose to or not to correct it. Government might leave it in the hands of the free market to correct their mistakes. Government can also correct it. Government can correct it through government regulations like tariffs, imposing taxes on importation. Do you get what I'm saying here?
Yes.
There is government deficit through current account deficit, and there is current deficit from individuals buying or doing billions of transactions from abroad. So if the current account deficit is from the individuals, government may choose to correct it or not to correct it. Government might leave it in the hands of the free market, meaning that you are doing the transaction should stop it. But if government has to correct it, government will do this by coming up with policies, regulations. Example, importation of tariffs, imposing taxes on importation. And if government imposes taxes on importation, it means the volume of imports will reduce. As a result, the current account deficit might come back to balance or surplus. Do we get it? So all what we have to talk today is about deficit in current account, deficit, surplus in current account, surplus in balance of trade, deficit in balance of trade. For balance of trade, we have surplus when export exceeds import. For balance of trade, we have deficit when export is less than import or import exceeds export. For the current account, we have surplus when our overall credit generated is more than the overall debit generated. And we have deficit when our overall debit is more than overall credit. Then, for current account government spending deficit or current account deficit, it can come from individuals because individuals do transactions, and it can come from government. But if it comes from government, it would have meant that government spending was financed through borrowing from abroad. So government has to correct that. It is not left for the free market to correct. But if it is from individuals, government might choose to correct it by imposing taxation, import on taxes. That is tariff. Or government might leave it in the hands of the free market to correct their mistake. That ends the chapter. Any question?
No.